He's mostly just talking about how they're getting a bit too expensive right now. And this is, as you had mentioned, coming from, I would call him a perma bear, David Rosenberg. He's another one of those guys who kind of like Burry predicted the 2008 crash, but then kind of went on to predict numerous other kind of bearish scenarios over 2 decades.
Welcome to the Canadian Investor Podcast. I'm Simon Bélanger. I'm here with Dan Kent. We have a fun episode coming up today. We'll be starting with a recent article that was published by David Rosenberg in the Globe and Mail asking if Canadian banks are in a bubble. So we'll go over that and you'll give your thoughts. I'll give my thoughts as well. We'll be showing some charts. So if you're hearing this on audio, you can always hop on YouTube. The full video will be posted on YouTube as well. Our Patreon subscribers at jointci.com do get it early, an early release for the full video, but YouTube, it will be posted on Monday. And we'll be just showing some charts, whether we agree or not with David. And then afterwards, we'll be talking about bonds and whether they still have a place in your portfolio. So about a month or 3 weeks ago, we did an episode where we talked about bonds versus bond ETFs. And we generally looked at it, whether it was still a good look or not for the portfolio, but we only went over at a glance for that more specifically. In this one, I'll specifically look at whether bonds or bond ETF makes sense in a portfolio going forward, some of the risk versus some of the historical returns, and why the 60-40 portfolio has performed so well. So some really interesting charts that I'll be sharing with that. But we'll get started with the Canadian banks because I think this is where a lot of people are looking forward to, whether David Rosenberg is out to lunch or not. Are the banks in a bubble? Dan, get us started on that.
Yeah, so I think the term bubble is thrown around way too loosely now. Whether it's this whole AI thing that is causing a lot of bubble talk, but it just seems like every industry or sector that gets slightly expensive, people start calling a bubble. I don't think you can call these companies, they're trading at 17x earnings and posting right now 17+% returns on equity. I don't really think you can call them a bubble. There is plenty of bubble-ish spaces on the market that I would say, and I really don't think banks are one of them. I'm not really all surprised at the title of the article, however, because it gets clicks. The one thing I will say, because a lot of people will probably be paywalled from this because it's on the Globe and Mail.
Yeah.
The article is not as bad as the title makes it out to be. Like, it's actually a pretty reasonable piece talking about the banks. So if you can't read it, it's not as bad as it seems. He's not saying these banks are going to collapse and they're in a bubble. He's mostly just talking about how they're getting a bit too expensive right now. And this is, as you had mentioned, coming from, I would call him a perma bear, David Rosenberg. He's another one of those guys who kind of like Burry predicted the 2008 crash, but then kind of went on to predict numerous other kind of bearish scenarios over 2 decades. And
yeah, isn't it the line where he's predicted the last 10 crashes that never happened or something like that?
He's predicted 9 of the last 2 recessions.
Now, to be fair, I've listened to him quite a bit. He's been on podcasts. I've read a lot of his stuff as well. And he's a very smart guy. He's into the data. And like we were talking before recording, I think we could look back in 10 years from now, 15 years from now, and just look back at some of the predictions that David Rosenberg did and just say, okay, he was just early on those predictions. Yeah. Of course, in investing, early is as bad sometimes as being wrong. So you have to keep that in mind. And another quick note, if you do have Apple News, you should be able to get this article included for free with your Apple News Plus. So for Apple subscribers, I just wanted to mention that because that's how I pick up a lot of the paywall content for stuff like the Globe and Mail.
Yeah, he is a very smart individual. I'm not going to say he isn't. He was generally he's just been bearish on US equities. I know he's fairly bullish gold, I think anyway.
Yeah,
he's bullish
I believe
gold. He was bullish fixed income bonds as well, which hasn't turned out too well, but he's not just a fear-mongering type perma bull or perma bear. I mix that term up so many times, I don't know why, but
it's okay.
There's a lot of good insights into what he's saying. He's just been wrong on them for a long time. And like you said, being early, we went over this with the equal weight S&P 500 ETF, like if you should transition from cap weighted to equal weighted. And we had mentioned there again, being early is just as bad as just being wrong. So yeah, my opinion out there immediately, and then dig into the details. No, I don't think the banks are in the bubble. I just think it's way too loosely used of a term right now. When you look at a bubble, when you think of a bubble, it's effectively, you turn into greater fool theory. So you just got to hope that somebody else is willing to pay what the stock is trading at right now. Valuation multiples expand rapidly, don't really follow fundamentals. And once the fools disappear, the stock craters. And usually in those types of situations, it's 50, 60, 70+%. So
yeah,
I think the headline is
the prices are almost distorted from reality, right? Like that's a good way, I think, to frame it. I agree with you. The bubble term may be overused a bit. I think it's more applicable to what we're seeing in AI now. Although some will argue that a lot of the high flying AI names that we're seeing are still putting some really solid earnings, but then again, I think there's counter arguments for that, where I think there's definitely more of an argument for AI for the banks. I think I would agree, and we'll be showing some of the stuff that David is referring to in that article and what's leading him to believe that. I wouldn't say like he's really saying it's in a bubble. That's probably more the title. I think it's more he's saying that they're overvalued is probably a better term.
Yeah, they're just too expensive right now, which I would tend to agree. So if you look at the banks right now, they're trading at around 60% premiums to their historical averages. So it is no doubt expensive. But if you actually ignore the headline and dig into the piece, like you had mentioned, he really doesn't mention that they're in a bubble at all. He just kind of speaks on how expensive they are. And I own bank stocks myself. I will likely never sell the banks outside of just routine rebalancing when I need to. And if they continued to run up the way they were, I probably would take a bit more off the table at the end of the year. I typically do it at the end of the year. I did it last year. Again, I thought they were expensive last year, so I kind of trimmed a bit back, and I was wrong. They're up quite a bit. If we look to ZEB, which is BMO's equal weight banking ETF, it's up 33% this year, probably 35% plus with dividends, and it is up 70% on the year. So they've done very well, and it's kind of like bank stocks' impact on the TSX right now is it's similar to AI stocks in regards to the S&P 500. It's not as drastic, but right now, Canadian banks make up over 25% of the entire TSX. I don't know if we've ever hit this level of concentration. You won't get, there's a lot of available data on the S&P 500's concentration. You won't really get this with the TSX, but from what I have read, they've never made up a quarter of the index. So you're getting pretty high there. And the one of his main points, and the one that I actually do agree with, is the earnings quality of the big banks right now. A large amount of the growth is just coming from decelerating provisions and capital markets. I'll get to that in a bit, but we saw large buildups in provisions over the last few years, which kind of impacted earnings. And now those provisions they're not necessarily going away, but they're decelerating quite a bit. And the only issue here is once that tailwind goes away, which it inevitably will, provisions, they will either kind of flatline or continue to slow even further, or potentially even go up a bit, like what ends up happening. And as someone who holds the banks and kind of dives into them quite a bit comes earning time, you can definitely see this. Loan and deposit growth are not particularly strong among all of the Canadian banks. I don't really want to call it weak. It's not certainly something that warrants 70% plus share price increases, though. So I think most of the banks are growing deposits and loans in maybe the low to mid single digits. I might be wrong on a few. Some of them are doing quite well, but most of them, the underlying growth of the loan side of the business is really not doing all that well. And then you factor in the capital market segments. Those have absolutely exploded over the last while. And they're going to be coming up against some very difficult year-over-year comparables. And this segment is the one that's ultimately at the mercy of the markets in general. If they turn soft, if inflows slow down, the markets dip, whatever it may be, wealth management slows down, this segment will get hit. It's just kind of the way it goes. It's arguably the most lumpy segment, I guess you could call it, of the banks, and it has been forever. And then there's the other element of the mortgage renewal wall, which is, I'm iffy on this. It just seems like over the last 2 or 3 years here, it's been like you just wait and see type situation, but it's never really happened. Is it still a risk? Sure, but many Canadian homeowners have absorbed higher rates coming out of the pandemic very well. The mortgage portfolios of these banks are really not under a lot of pressure. So I know he does talk about the mortgage renewal wall, which was supposed to happen last year. Now it's going to happen this year. And then he kind of mentions that it could happen in 2027 again. I don't really buy that side of things anymore. I don't think it's a massive issue for that. But if you look to valuations, and I think, are you going to show that chart here? I guess you can show
it.
The earnings chart here. For the highest quality Canadian banks, we're sitting at probably around 17x earnings. So I'm pretty sure Royal is above this. National is probably pretty close to that as well. And when you look to 10-year historical averages, these banks, so Royal is that's got to be Royal at 18.2.
Yeah.
Yeah, so you're talking 18x earnings for Royal Bank. And
yeah, for those listening to audio, it's up and to the right. Like it's not as you'd expect for a bubble, but it stands out when you look at the charts where you're looking at the last 6 months, roughly half a year. And it stands out there's a big contrast versus the previous 10 plus years.
Yeah, like these banks, I think Royal maybe would have traded around 2x book, and you can kind of tell by this chart. That would have been pretty much it. Maybe 1.8 to 2x. But the other banks have
it's actually rarely over 2x. It's very rarely over 2x book. Yeah.
Yeah. So these banks barely ever trade at the valuations that they're trading at outside of, like you mentioned, the last 6 months. So you see many of the banks growing at a 20% plus clip, but pretty much every one of them is followed by kind of declining provisions and accelerating capital markets. So I think a lot of these banks over the last quarter, I think provisions were declining 30%.
Yeah, you can see here. So to the far left, you see the provisions that were back a year ago, so Q2 of 2025, and then just compare that to the most recent quarter. So I think the only bank that was about in line was CIBC. I think everything else is lower provisions on a year-over-year basis.
Yeah, and the reason CIBC is the way it is right now is because they would have been previously, that's why they did so good in probably 2024, is they booked a ton of provisions earlier on and then realized they kind of overdid it. So they started decreasing provisions way before the other banks. So that's kind of why you see them flat. Whereas if you look to Royal in Q2 2025, they have 1.4 billion. Now they're down to 912 million. So it's definitely declining provisions, which is vaulting a lot of these banks right now. If that kind of went away, earnings would not be growing at the clips that they are. So you have that, and then you have the capital markets, which are two situations that will inevitably fade away. You can only lower provisions for so long, and the capital markets can only stay strong for so long. It's pretty much, if you look to the banks throughout the past forever, it's such a business that is, the capital market segment is an absolute roller coaster. If the markets go flat or if the markets go down, they're going to struggle in that area. So Canadian banks right now are some of the most expensive banks in the world valuation wise. You could get US banks for cheaper, you can get European banks for cheaper. So I don't know if you have anything you want to go over here.
Yeah, well, I actually pulled before we started recording, so I wanted to show some interesting visuals here. So the price to book, if you look at the US banks, I only took 4 that were probably the most comparable to the Canadian banks. So JPMorgan, Bank of America, Citigroup, and Wells Fargo. Some people may ask, why didn't you put Goldman Sachs or Morgan Stanley? It's because they're more like wealth management investment banks, where these are a bit more diversified. They're not perfect comparison to the Canadian banks, of course, but it's a better comparison than the other two. And they're obviously some of the larger US banks. And then if you looked at the forward PE, again, comparing that to the Canadian ones, it looks way more attractive for the
Yeah.
US banks. So JPMorgan is trading at the highest multiple at 14. And then you have the lowest multiple of Citigroup at around 11. And then the other two are in between. And then when you look at the Canadian banks, the cheapest Canadian bank is Bank of Nova Scotia at 14. And you have Royal at 18. So you can see that you're essentially paying the same price, Bank of Nova Scotia versus a JP Morgan. And I'm not a bank expert, but if you ask me what do you prefer between JP Morgan and Bank of Nova Scotia, I will buy JP Morgan every single time if they're at the same price.
Yeah, you have probably the best US bank versus a Canadian bank, which is pretty much going through a full-blown turnaround right now because its Latin American segment was doing so poorly. And you have to pay more for Scotia than you do
Or JP Morgan.
which is it's
the largest bank in the world.
Yeah. And it's trading at a cheaper book multiple, and it's trading at a cheaper... Well, actually, no, it's not trading at a cheaper book multiple than Scotia, but I think on an earnings basis, it's about the same, slightly cheaper. So
yeah.
I said the article, he mentions that the fundamentals are there, but the price is just way too high right now, which is, but yeah, I would tend to agree. I don't think the article is that bad. I think a lot of people are reacting negatively to it because
they don't even read it. A lot of people won't even read the article to just see the title.
Yeah. Well, and I seen it I responded to a post on X about somebody who effectively talked about this article and how it's just, the banks aren't in a bubble, whatever it may be. But if you actually read the article, he's not really saying they are. I don't know if he had a choice on what the title was, but I would imagine what ended up happening is a lot of people seen this. They clicked it, hit a paywall. They couldn't read the article, so just assumed it was a very bearish post on Canadian banks. It's really not. It's just talking about how expensive they are. And again, I would tend to agree. So the one thing I would say is the market right now, I guess I'm far from an absolute bank expert, but it seems to me like the market right now is pricing in continued declines in provisions, which if these banks continue to post 30% declines in year-over-year provisions, it's hard to imagine they don't grow earnings at a 15-20% pace because their Royal Bank is booking 500 million, 500 million less in provisions year over year. So that has to continue. I would say that would kind of be what would break this whole thing is if provisions stopped decelerating at the pace they were, because then obviously you have earnings don't grow as much, and these banks at 18x forward earnings are priced for very high earnings growth. I have been a net seller of Canadian banks for the past couple of years, but it's really at the end of the year when I just kind of do a bit of rebalancing and I trim them back down. I don't really like the banks to be any more than 5 to 7% of my portfolio. And right now they're kind of getting up there. So
yeah, and he's just saying in the article that investors should consider taking profits. He's not saying to sell all of it. So I think that's an important nuance. Taking profits, sure, you can be taking profits and just liquidate all your positions, but you can also be taking profits and just do a bit like you rebalance. Maybe you trim 15, 20%, you take some profits that way. I think that's completely reasonable. And the other thing, I don't know if you mentioned it, but he also said the underlying business of the bank, so the savings and loans, what banks are traditionally are. So I know you talked about the wealth management, the markets, the investment banking side, all of that stuff doing extremely well. But he also mentioned in the article that the kind of traditional or the base of the bank's business, those are not that they're doing poorly, but they're not growing very much. Good. No, exactly. And this is not much different from the US, by the way. A lot of the banks, the savings and loaning, it's not something that's growing all that much. And it probably is a reason why OSFI, so the Canadian regulator, actually lowered requirements. So in terms of the required capital that's required on the balance sheet, so in terms of the regulatory requirements, they're essentially encouraging banks to loan more. So we'll have to see whether that's a little bit of a reflection of what we're seeing with the banks right now.
Yeah, they had that situation where they lowered the capital buffer, but the thing about it, well, it's difficult because the thing is they don't need to loan the money. They can buy back shares or raise dividends as well.
Need to. They're trying to
Will-
encourage them, but it's still
Yeah.
up to the bank. They're basically saying you have more than enough provisions or capital on your balance sheet to absorb losses. You should consider loaning more. But considering loaning more doesn't mean that they will.
Yeah. And buybacks at 17x earnings are probably not all that attractive to them right now, because they would know, these management teams probably know that they are very expensive right now. So you could see, yeah, like you said, they don't have to loan. They could easily just start increasing the dividend by double digits. That would probably be the situation that I would probably expect. But if provisions continue to decline, I wouldn't be surprised if they didn't just continue to buy back a ton of shares. So on me trimming the banks, again, this is a situation where I was early, but I kind of had a strategy, stuck to it. I'm pretty content with the results. Again, it's not really detrimental for me because they don't make up a large portion of my portfolio anyway. Just on the article in general, I would not be rushing out right now to sell Canadian banks, but I would probably not be adding to them. I have not added to them for a couple of years. I think if you're in a position where you're very heavy Canadian banks, which is, let's just face it, is a ton of Canadian investors, just look at your portfolio, ask yourself if that amount of exposure is reasonable to you, and if it is, I just don't really see why you'd be rushing out to sell these companies. If you're over allocated, you say maybe I'm a bit too exposed. I don't think there's any problem at all to taking profits. Reasonable level of exposure will ultimately vary wildly. It's all personal. I don't like having any more than 7-8%. When it gets high, I usually take a bit off the table, but I do know some people with very large portfolios as well that are 30+% Canadian banks. So it all just kind of depends on you. But yeah, if I feel I had to talk about this because I do think the situation is a lot of people hit the paywall and they immediately assume that the article was super bearish. Obviously, you put bubble in the title and Canadian banks, it is going to spark a lot of controversy, and I think that's why they did it. But the article is a very reasonable read, and I would suggest if you don't pay for the Globe, kind of try to find a way to read this, whatever it may be, through Apple News or whatever you said you get it for free.
Yeah. Well, it's included with the News Plus subscription. So you have to, I believe, be subscribed to News Plus, but you'll get it if you are. Yeah.
Yeah, and you're allowed to give out gift articles, whatever it may be, for Globe and Mail. So I got to read this one through a gift article. But yeah, it's a good article.
Yeah, and I think right now they have some promotions. Like, we don't have any, we're not, like, they're not advertising or anything on the podcast, but affiliated. But I think you can get it for 50 cents a week that I'm seeing here on the website for the first 24 weeks. So if that's interested to you, but if not, the article is much different than the title. That's I think that's a good takeaway. So let's move on here to the second segment. So wanted to do a follow-up on the bond episode like I talked about at the beginning here. Got a comment regarding the bond episode, and I can't remember the name, but the listener asked if we could elaborate a bit more if bonds still make sense in a portfolio. And I'll approach this from a perspective of the asset class as a whole and not differentiate between bond ETFs and individual bonds too much, because at the end of the day, there are some differences, but at the end of the day, your total returns will essentially be very similar. They'll just be a bit calculated in different ways. So I'll use US Treasury bonds here as the baseline because, let's be honest, Canadian government Treasury bonds or corporate bonds will largely go in the same direction as the US Treasury bonds. For corporate bonds, there's going to be a credit spread between what US Treasuries are paying and corporate bonds in the aggregate are paying. And of course, that will vary depending on the credit quality of the business and other variables as well. For the Canadian government bonds, there's other factors that will impact the price of Canadian government bonds, including projected economic growth, inflation expectation, overall demand versus supply for Canadian government bonds. But the US yields will have a big impact. The reality is US government bonds and the yields impact pretty much everything in the fixed income market. Yeah. So I think it would be, I know we're Canadian, it's a Canadian investing podcast. We do look at Canadian topics, but it's when you just can't ignore the elephant in the room or the elephant down south. You just have to acknowledge it. And a quick note here is that technically anything that is 10 years or less should be called a treasury note or treasury bill if it's less than 1 year, while 10 plus years is called a treasury bond. But for the purpose of this, I'll deviate a little bit here and just call anything that's 5 years or more treasury bonds. So just so I don't get something in the comment, it's just easier to understand in terms of just trying not to get into too much the technicalities. So back to the question, Dan, do you think bonds still have a place in your portfolio? What's your quick answer on that?
In my portfolio, certainly not, because I'm in my mid 30s. I don't know a lot of people who, even like retirees, who own a lot of fixed income. It seems like for a very long time, a 60-40, whatever it may be, was a very popular strategy, but bonds have gotten destroyed by equities for a very long time, to the point where I think a lot of people are kind of going sour on owning them. I don't know. It's very difficult. Obviously, if you're buying individual bonds, especially high quality, high grade bonds, you're not guaranteed, but you're virtually guaranteed to get your money back. If you think about it, if you're buying a bond from a company like Enbridge or something like that, there is a very low risk of default. So you're getting that coupon, you're getting your initial capital back. But most people don't go this route. They go the ETF route, which doesn't really, under the surface, this is all happening, but it's not really the same thing that's happening in the ETF price. So you can be kind of underwater on a lot of those funds. But I don't know. I don't really see the attractiveness of them, but it's also like we've been blinded by 20 years of very, very good market activity.
Yeah. So I think my answer is a little bit more nuanced here. So first of all, I'm sharing for those looking at the video. So if you look, this is from the Federal Reserve. So really good chart. You can look it up yourself. If you look, it goes back to 1977. So essentially looking at the 30-year US bond yields, and bond yields peaked in the early 1980s. They were yielding around 15%. And ever since then, essentially up until the spring, summer of 2020, you were in a downward trend for bond yields. So the reason I want to mention that is because this was a huge tailwind for bondholders. During that period of time, it was really great to have a bond allocation in your portfolio. If you had a 60-40 bond allocation, so 60% equities, 40% bond, you did quite well. You, of course, would have done better with just equities, but it still would have done quite well for you. And then when you start comparing, I did some really interesting charts here. So just comparing this one here. So I did a chart. I compared TLT. So TLT is the iShares 20 plus years US Treasury bond ETF. It was created in July of 2. So essentially I use a date when it was created up until July 2020, so July 22nd, 2020, because I figured it's like a 20-year period. And it's around the time that interest rates on the 30-year actually bottomed. People might think it bottomed later in 2022 when the Fed started raising rate. Well, that's the short end of the curve. If you're starting to look at longer duration bonds, they actually bottom in the spring or summer of 2020. And if you look at the total returns in that 20-year period, so from 2020, it did really good. Obviously, it did not do as good as the S&P 500, although during the COVID lockdown, the start, it was actually quite close in terms of returns. You would have been almost like neck and neck in March of 2020. But during that period of time, the S&P 500 did 467% and TLT did 285. So you did really well. And if you start looking here, and again, I'm using some US data just because these are US government bonds, but still pretty useful. And I did they have a CPI calculator for the US Bureau of Labor Statistics. And I used the same time frame to look at what $100 was worth back in July of 2000. Actually should have done. So that would have been essentially $100. You had about 43% inflation during that period of time. So clearly, some people might say, you know what, that doesn't make sense. It should have, the dollar lost more than half of its value. That's fine. You can debate all that all you want. Doesn't really matter. All that I wanted to show is that I think it's safe to assume that you actually increase your purchasing power. So your real rate of returns were positive, and I think that's really important here because it's not the same thing that happened in recent years. And if you're starting to look a little bit here at what happened in the last 6 years, Dan, do you want to take a little bet here of what happened?
Crushed.
You got absolutely crushed. So if I take the same July 22nd, 2020 date up until today, so essentially 6 years to the date, so you lost in total return. So that includes a coupon payment. Again, using TLT, you lost 40%. So in real terms, if you factor in inflation, I don't know exactly how much you lost, but I think it's safe to say that you probably lost 60% of your purchasing power, if not more.
Well, and this would be... Obviously, it depends what account you hold them in, but this would be pre-tax as well. So if you, like, compared to capital gains, obviously the S&P 500, you're getting some dividends, but the majority of your returns will come through capital appreciation and capital gains. If you held both these in a taxable account, it would be even worse because that interest income, even though your bonds are losing value, you're still paying interest income on that.
Yeah, but you could have, you would have taken a loss, right? So you would have had a capital loss of, you would have lost 50% of your capital. So I think, you would have been taxed on that for sure, but at least you could offset the capital gains later on.
Yeah, but you couldn't offset that interest income tax with your capital loss.
No, for sure.
So they're not very tax efficient. That's the one thing. So you do not it's effectively the worst form of investment income you can get would be interest income, which is what these bonds pay. So when you look at a post-tax basis, it gets a little bit worse. It gets much worse. But like you had said, you would have been able to book the capital loss on the absolute wreckage of bonds through 2020 to 2026, whatever it may be. But it was pretty much solely from the rapid increase in interest rates. And that's why they did so well during the post-financial crisis, kind of, because you had mentioned
or
how
even
they started.
AIDS. Like, essentially, it was a structural trend. Like, it happens over decades. It wasn't just the financial crisis. And that's what I wanted to show is, like, I think this is the other side of the coin where the last 6 years, you got completely destroyed. And the other one I'm showing here on the chart is U.S. Treasury bills that are 3 months or less. So I just used the ticker BIL for the ETF, which during that 6-year period returned 19%. Why? Because there's little to no duration risk because they're constantly rolling over. And the other reason is that you've been getting between 3 and 5% depending on when you bought them. Obviously, during which time period in 2023, I think we were getting closer to 5%. So if you held those, you actually did decently well. Did you keep up with inflation? Again, your real rates of return, probably not. I'd argue that inflation during those 6 years is well above 18% or 19% if you round up.
Yeah, it was 9% a year there for a bit. It was pretty ugly. But yeah, that's why they did so well pre-COVID. When you own these bonds and interest rates go down, obviously the bond you own will have a higher coupon, so it will go up in value. Whereas the complete inverse happened in 2022. You had very low paying bonds, interest rates go up, and your bonds get wrecked. So I think the last 6 years has soured a lot of people on the whole fixed income situation. But like you had mentioned, it didn't really do all that bad pre-rapid inflation, which shows you how, especially when you get to the longer duration of bonds, how much of a risk inflation is to these, inflation and interest rates to these longer term holdings.
Yeah, exactly. And like you alluded to it, like if you held like U.S. Treasuries specifically, you would have done pretty well during the financial crisis. So during short periods of time, you would have outperformed stocks quite well. During longer periods of times, no, but you could have made a really good case during the last 3-4 decades prior to 2020 that having that a 10, 20, 30, 40% bond allocation in your portfolio was a good balancing act between that, having that fixed income compared to having equities. But I think to me, it all comes down, can you at least match inflation? So if you So I think that's really where the question is, whether deciding to have bonds in your portfolio or not. And again, I'm talking here like longer duration stuff. So at least 5 years, I would say, for the most part. And of course, the longer the duration, the more risk you're taking on. So the term premium is greater because you have more uncertainty as to what inflation is going to be. So whether you're going to get, if you're looking at right now, the US 30-year, which is paying about 5.1%, it might look pretty decent. But 10 years down the line, are you so sure that inflation will be 5%? Will it be higher? Will it be lower? So there's a lot of uncertainty involved with that. Of course, you can always go with the 10-year right now that's paying 4.6%. So there's a little bit more visibility on what's happening in the next 10 years. But again, 10 years is a long time period. And of course, if you own the individual bond, you could say, well, I'll just hold it to maturity. But that's where you get into an issue. If you're getting that 5% on the 30-year, but inflation is 6-7%, or on average for that 30-year period, people might think, oh, you're crazy. Well, you don't know what's going to happen in 5, 6, 7, 8 years. So maybe we'll be in higher structural inflation. Same thing could happen with the 10-year. Maybe it's paying 4.5%, but inflation's closer to 5%. So you're seeing your real rates of return actually declining. And that's why we invest. We invest because we want to at least keep our purchasing power, but ideally increasing it. So at the end of the day, longer duration bonds, you really have to ask yourself, where will the economy be in 10 plus year from now? How will inflation trend? How will deficit trend? How will the national debt trend? And of course, if you're investing into a company, you have some additional risk. You could have some credit risk with the company. With the governments, it's a bit different because, of course, they can always print money, but the more money that you print, the more the fiscal situation, the more they spend, the more it gets out of control, the more inflation has a higher likelihood of increasing. So you're taking on that risk. So it's really a trade-off between trying to lock in that yield versus the risk that you're taking on the inflation side and the potential of just not matching that inflation. Because if you buy the individual bond, sure, you can get it to maturity, but that's the risk there. If you buy the bond fund, like I just showed with TLT, then yes, you can sell whenever, but if you bought TLT in 2020 or 2019 and you sell now, you're looking at some pretty steep losses, even when you factor in the interest income that you got from that. So in terms of alternatives, at the end of the day, some might point to gold as a good alternative for hedging your portfolio against long-term inflation. It's hard to disagree with that, but as we saw in the recent year, gold can also be pretty volatile in the shorter term. I think it's a good argument to make when you're looking at longer periods of time. But if you're looking to have something more stable in your portfolio, then I think a viable alternative is looking at shorter duration treasury bills or notes, so 5 years or less in duration. Obviously, the shorter the duration, the less risk that you have more visibility on inflation in the short term, but you also you'll get a bit less yield in terms of that. So that's one of the trade-offs that you'll have. And right now, if the Fed starts cutting rates in the next year and a half, which I don't think is that far-fetched, then are you getting paid 2.5%, 3% versus inflation that might be running at 3.5%, 4%? We'll have to see. But then you're still looking at real rates of return that are below what inflation is, and you're losing some purchasing power. So that is really the trade-off that you're doing is, do you want to lock in that higher interest rate, but taking risk in terms of not knowing what the future will bring, especially so far in the future? Or are you happy with potentially undershooting inflation, but at least you don't have that duration risk and you have more liquidity up front?
Yeah, and I guess the only thing I would mention here is depending on what account they're in, is the post-tax situation as well. Because even if you're earning 4.5% and inflation is even 3 post-tax, you're probably still negative on a real return basis. Because again, these are very tax inefficient, I guess you could say. But yeah, definitely not a hedge against inflation. They're the reverse in that fact. If you get high inflation, a lot of these longer term bonds get hit very hard. Whereas if you go to the lower, shorter term, there's so much rollover there that they aren't really impacted in price all that much. That's why you see a lot of those like 3 to 6 month treasury bill ETFs, they barely move in price at all because they're just constantly rolling over into new ones. There's just not much impact there. But yeah.
But it's basically a slow bleed, right? So that's the issue, is that you slowly lose purchasing power, whereas you have more of a risk when you go into the longer duration. But of course, you could have more upside as well. Who knows? Maybe the 30-year, 10 years from now is yielding just 3%, and you've done pretty well when you bought it at 5.1%. So it goes both ways. Just wanted to mention, in terms of what I'm doing personally, I don't have bonds in my portfolio. I do have close to 10%, mostly in US Treasury bills. The reason why I chose US is they're yielding more than Canadian Treasury bills right now. So that for me makes a whole lot of sense. Of course, you have to factor in currency exchange that can fluctuate, although I do think the US dollar going forward has more of a probability of remaining relatively strong just because of what we're seeing in the world and the constant demand for US dollars. And I do manage my parents' portfolio. They are retired, and for them, it's pretty simple. They have 15 to 20% in cash at all times, and the cash, the majority of it, again, is US Treasury bills, 3 months or less. Something I am considering is looking at 2 years, because the 2-year is usually a good gauge of where the markets thinks that rates will be going with the US Fed. And the 2-year, I think, is yielding slightly above 4. So the market is pricing in some potential rates increases, although I will be honest that I think the market's a little bit wrong here. I don't think the Fed will be increasing rates. I think there's just some forces that are making it very difficult for them, because the US is financing more and more with treasury bills, and increasing rates would just means that the interest payments would be going up for the US government. So I think that is going to be a big sticking point here. And I think they are ready to accept slightly higher inflation to make the debt more manageable in the years to come. So that's my thesis on that. But I am looking for my parents potentially buying some 2 years to bump up that yield a little bit. And if you want to see what I'm doing, I share this on jointeci.com every 15th of the month, the moves that I do for their portfolio. And we share our own portfolios and the first of the month every single month. But that's what I'm thinking at right now. But I think the biggest takeaways for bond right now is that personally, I just don't think they are worth a risk when you go really far on the duration. Of course, you can look at corporate bonds, but like I said, there are some other risks that you have to contend with when it comes to that. And I'd rather own shorter duration, even if it means I'll learn a bit less than inflation, because I think that's a lesser evil or a easier pill to swallow than taking the term risk.
Yeah, and for me, I just have such a long way to go that I've never really considered holding them. I think if you have a long time horizon, I think equities have historically proven to outperform fixed income. But I think as you get closer to retirement, it's something to consider. But I know a lot of retirees that have very little interest in them. They mostly go the dividend stock route, which again is probably the result of a 15 plus constant bull market. So yeah, I don't plan on holding them anytime soon. That's all I got for this. It was a pretty good segment. They're relatively mysterious to a lot of investors, even though they're very easy to purchase now with an ETF. But I find a lot of people, you're told to own them as you get closer to retirement, but it all depends on your individual portfolio, what you want to do with it, things like that.
Yeah, and just looking at the US 2-year bond yields, so we're recording in this on July 20th, and it is yielding 4.22. So it's actually, to me, that is quite attractive right now for fixed income, because you don't have too much duration risk to contend with, and you're looking at a pretty decent yield, especially when you're looking, I think, 50, 60 basis point lower for US Treasury bills. So that, speaking for my parents' portfolio, I think I will probably be adding a little bit of that. I'm not saying you should do that for your portfolio. That's just what I'm doing for them. They are in a very different situation than you and I are, Dan. But I think maybe the biggest takeaway is that they could still have a place in your portfolio, but there's a lot of things to consider, I think, just before making a 60-40 plunge, like used to be the, I guess,
Go-to.
the standard. Yeah, the go-to. I guess it really didn't matter, huh? 60-40 all the time. Didn't matter how far or close you were from retirement.
Well, I don't know. I wasn't told when I was very young to go 60-40, but it was kind of the portfolio, and it did very well. And then during COVID, I think it had its worst stretch of results in history. It just got obliterated. But yeah, things change.
Yeah, no, exactly. So I think that's a good way to end it here. Let us know what you thought about the episode. Again, this one will be posted on YouTube. So if you'd like to see the graphics that we shared quite a bit when it comes to the banks, and that'll all be on YouTube. And of course, if you just want income, you can always go buy the Canadian banks. So
yeah. Well, yields are pretty low right now.
The yields are pretty low, so maybe you're better off buying some US Treasuries instead. How much are they yielding before we wrap this up?
Oh, the banks are probably yielding on average, I would say, below 3% now.
Oh, really? Wow. Okay.
Here. Let me try to find ZEB's yield. 2.3% on ZEB.
Oh, wow. Okay.
Which is,
very low.
I think if we look to a company like Royal, that would probably be 2.37% on Royal Bank.
Wow.
Which is well below what it usually pays. Yeah.
Oh, that's
I think
crazy.
the highest yield is probably Scotia right now, and even that's only 3.7. Like when Scotia was doing rough, like it was yielding 6%, I think, pretty close to 6%. Yeah. So yeah, you're not getting much dividends from the Canadian banks right now, but you've also had a mountain of share price appreciation, so works both ways.
Yeah. Okay, I think that's a good point to call it. If you own Canadian banks, congratulations. And for the rest of us, we'll just go cry in a corner. So thanks again for listening. We will be back with another episode on Thursday.